We start off with a make-or-break moment for this market, and that is right. The S&P 500 in the danger zone. Right back the levels. It was at its breaking point back in December, and after a dramatic fall and even more dramatic bounce back from the bottom, a 10% move higher from the Christmas Eve lows, the stocks make a run for 2,600 once again. So with the Fed seemingly in check, some progress on the trade war being made, will the market make it out of the so-called danger zone? Dan.
Yeah, well, listen, you set it up as kind of a dramatic setup here, but it is kind of dramatic.
You should have said thank you, Maverick, or Viper, even for that matter.
Okay, fine, there, Iceman. But here's the deal. Listen, that 2,600 level was really, really important because from the October highs, we had this decline. We got back down there. It's a level we had bounced at. It had been technical support for a little bit. And on December 14th, when it broke, it went straight down. So here we are. We're right back there. One of the things I think is really important, I think you want to look at a couple of the sectors that led on the way down. We've been talking about bank stocks in particular, the XLF, and then let's talk about the XLI, the ETF that tracks industrial stocks. Two very cyclical groups here, and really, let's remember what was going on. There was a bit of a growth scare back then in December. So when you look at those two charts, the XLI and the XLF, they're also approaching those breakdown levels here. So to me, I think if they get there and they can't get above there and they fail, then you continue to sell rallies. I do think it's a tough spot to continue to press lows. But XLI, XLF, the really keys, the S&P 500 has to get above 2,600 and stay there and has to become support.
Well, he's too close to missiles, and I'm switching to guns, Mel. So bottom line here, it's a top one.
I got it.
I mean, come on, people.
I was all over it, Viper.
Come on.
No idea what you're talking about. Anyway.
Bottom line here is I think the Fed actually takes you out of the danger zone if you believe the Fed minutes were consistent with what Powell gave us on Friday. And that's a Fed that's not predetermined to be robotic and follow, essentially a protocol rather than follow the data. And I think we've had reaffirmation of that. We've all speculated very well. You started it, Mel, talking about, is this a guy that had to follow a script? Or did he have to stick on course as Powell learned about his messaging? But what I think we learned from the Fed today is a couple things. And Rosengren had some comments this morning that the market may be actually overstating the markets, the economy and the weakness in the economy. And that's actually a Fed that, to me, might be ready to jump back into the fray. The most important things for me right now are the fact that Asia, to me, last night inflected. And I think if Asia starts to recover, and I'm not just talking about China, because I don't really care as much about the local markets there, but look at Korea, which is both, an industrial exporter and also obviously the epicenter of a lot of the tech worries. And look at the dollar weakness, the Dixie, another weekday signaling, I think, clear for crude, which we talked about at the top of the show, and emerging markets, which are near the 100-day.
The dollar, to me, is the key to this whole thing, right? We had a very weak dollar today, although I'm not convinced that the Fed is out of the picture. My read of what the Fed said is they want the 10-year yield higher. They want a steep yield curve. Now, I don't know if the market understands that and can digest it, but when you're bumping up against 2,600 and you have the manipulator of rates saying we want rates higher on the 10-year, that could be a problem.
They control the 10-year.
They control the yield curve because they can sell long maturity and buy 2 years.
I guess that's true.
I think you had the greatest guest on last night, Mike Wilson. Has this guy been just dead on or what? I mean, he's been absolutely fabulous, and he talked about this rolling bear market, and now he's talking about a rolling bottom market. So I'm not getting too caught up right now in the idea that we've had a couple of great days in a row. Call it 3 days in a row that were absolutely spectacular. It's great to see some of this movement to the upside. We've lost a little bit of the volatility out of the market as well. I got to tell you something. To me, it still comes around the trade war. And that's really what the markets. I know you said the dollar. I think everybody here might have their own opinion. I just look at what the headlines are each and every day. Now that the Fed and after Powell read his script and stayed to the script of what he really wanted to project out there, and everybody now understands it better, and he went off script before, I think because of that, now it's trade war time. And everybody's looking at that. And depending on how things go, we've had a couple of decent days in terms of what we're hearing coming out of that. And I think that's what's really propelling this market right now.
So you sound skeptical, though. You actually sound like basically.
Yeah, I probably am more in the bear camp.
With Eagles writing checks, it probably can't cash.
But one of the things I would say is that sentiment obviously overshot to the downside in December. So we've had this kind of reflex move back up towards a level that we are all kind of comfortable with and kind of hoping it gets above. The reason why I think the banks are so important, we know that they start reporting Citigroup on Monday, and then most of the top 5 holdings in the XLF. If the XLF can't get above this level, this resistance level on good news, if there is any good news, then you got a real problem because then you go back to selling every rally in some of these very.
They've had volatility though, so you'd expect some of these banks to be those that are more involved in the actual markets themselves. They would probably be in a great position right now to maybe surprise people a little bit to the upside.
I feel like we've been waiting for the surprise to the upside
We
for a
have
long
been.
time.
Yeah.
And
For
even when
2018.
Even when the earnings have been good, the stocks haven't followed
Right.
through.
100%
In
agree.
fact, the playbook for bank earnings has been actually the first couple days, despite getting record earnings, the banks actually sold off.
Yeah.
Then it took about a week to 10 days into earnings season before people realized that the banks were, I think, delivering very good numbers. I'll say this quickly about the banks is they've been outperforming in a lower rate environment. They were essentially underperforming as rates went down and actually found a little bit of flight here. But look, as rates start to move higher again, although the yield curve has steepened, I think this has been an environment where banks have suffered.
Yeah, earnings, though, will be key. I mean, we're heading into the thick of earnings season in the next couple of weeks.
Yes, well, and we've already had a lot of the warnings, but that's why it makes it much more difficult here at 2,600 or wherever you want to take a look at the banks at. But because we've priced in a lot of the downside, and now we've rebounded and priced in a lot of, okay, maybe it's overdone there. And I do think the banks, I've liked the banks. I still like them because I happen to think the yield curve is going to steepen over 2019, not flatten out. But that being said, these are still stocks. And if the stock market itself doesn't digest that curve steepening that well, then I think the banks get hurt. So it's a lot tricky. And we've talked about it for the last several weeks about how this market going forward is going to be much more of a proactive trader's market rather than something where you can just buy and close your eyes.
But the setup into earnings, I mean, this is not the setup that you want into earnings. You don't want a 10% bounce off the December lows going into earnings. I mean, you're much better off selling off into the period.
I'll say this, though. I think the negative feedback loop of both the Fed and the market expectations is also something that the market needed to break out of. If you look at where we are today, again, we're back above that Fed day, whatever that was 3 weeks ago. I think the negative feedback loop for the market as you enter into earnings where, yes, we've had 10% essentially in 10 days is something that would worry me under normal circumstances, except for the fact that, so I am worried. But the negative feedback loop seems to have been broken, Pete, and I think that's important here.
Let me just make one point. Next week, we're going to have Netflix report, and I think that's a really important one. I don't usually say that. That's why I don't really talk about FANG. I talk about the MAGA, right? Because these are the mega caps,
really
the Microsoft, the Apple, the Google, and the Amazon. It did
Why are you
catch on.
pointing at Mel
Let
like
me
that?
tell you why Netflix
You're
is
like wagging your finger.
really
MAGA.
important here. Because high valuation did accelerate to the downside. Look at Netflix. It's up almost 40% from its December lows here. And these are the sort of names where I could see beaten down stuff that underperformed all last year have okay news and do just fine. We saw that like Lennar today. That's a really good example, okay? But I don't think stocks like Netflix are going to be afforded that same sort of wiggle room. So if there is any disappointment in those sorts of names...
So you think because of the fact that it's bounced back as much as it has, it's almost done. So they're really going to have to give some really great news.
So if they give an inline quarter...
I think it goes down on an inline quarter.